Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executives. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. In this session, let us talk about cash credit system. Cash credit is basically given for supporting working capital requirements of a borrower. It is assessed based on working capital cycle and generally sanctioned as a limit. It is this facility which accounts for major proportion of bank's credit. See, just now I mentioned that this facility is sanctioned as a limit. It means an assessed limit will be given and borrower can operate the facility within that limit. Say for example, if limit sanctioned is rupees 5 crore, then borrower should operate this facility within rupees 5 crore. If outstanding in facility exceeds the sanction limit, then it amounts to overdue and irregularity and all. On the other side, if outstanding is less than the sanction limit, then that is not an issue. Sometimes this facility may even have credit balances, but that does not mean facility is closed. The main reason is this facility works on cash cycle. So it is possible that at some point deficit will be peak, which may result in entire utilization of the sanctioned limit, and at some point there may not be any deficit but rather only surplus cash flows, turning the balance in credit facility into credit. So cash credit facility basically operates like a current account. All business related transactions will be routed through this account. It means borrower can deposit and withdraw any amount within the sanctioned limit. Okay. If you look at the securities, cash credit facility will have 2 types of securities. One is primary security, the other one is collateral security. Primary security is basically the assets that are created out of the facility. They are generally raw material, work in progress, finished goods, receivables and all. Even though the limit is sanctioned based on working capital cycle and available securities, operation of cash credit facility is regulated by drawing power. It means at the time of sanctioning cash credit facility, bank may stipulate a margin on inventories and receivables, and only amount net of margin will be permitted to drawn from the facility. This is achieved by insisting on something known as stock statement. That is, borrower should submit stock statement at mentioned intervals, which may be monthly or quarterly, and bank will arrive at advance value first. This advance value will be compared with sanction limit. If advance value is lesser than sanction limit, then advance value will be considered as drawing power, and drawings from the facility will be restricted to that level only. It means if a borrower has drawn beyond this drawing power level already, then that excess portion will be termed as overdue and it got to be liquidated at the earliest to avoid attraction of NPA norms. Okay, and on the other side, if advance value is greater than sanction limit, then sanction limit will be considered as drawing power and drawings from that facility will be restricted to that level only. Okay, so this gives rise to the understanding that drawing power is nothing but the lower of advance value and sanction limit. Let us look at this example. Bank has sanctioned a CC facility of rupees 5 crore and stipulated 25% margin on inventories and 40% margin on debtors. And here is the inventory and debtors information. Raw material 1 crore, work in progress 0.75 crore, finished goods 1.5 crore, debtors 3 crore. Now let us calculate the advance value first. See, for raw material, the gross value is 1 crore, but margin 25%, that is margin amount of 25 lakhs have to be deducted. So 1 crore minus 25 lakhs, advance value is only 75 lakhs. Then for work in progress, gross is 0.75 crore. So advance value is nothing but gross minus margin. Margin amount is 18,75,000. So we write it as 0.1875. So advance value is only 0.5625 crore. Similarly, finished goods 1.5 crore is a gross, 25% is a margin, so advance value is only 1.125 crore, whereas the case is different for debtors because the margin is not 25%, it is 40%. Gross amount is 3 crore, margin is 40%, so margin amount is 1.2 crore that got to be deducted. It means advance value is only 1.8 crore, and if you add all this, it adds up only to 4.2375 crore, whereas sanction limit is 5 crore. So what is going to be the drawing power? Drawing power here will be only 4.2375 crore, even though the sanction limit is 5 crore. Let's say the outstanding in the account is 5 crore. So what is happening now? There is an excess drawing which got to be regularized immediately. Excess drawing 5 crore minus 4.2375 crore, that is 0.7625 crore, have to be regularized immediately. Okay, so these assets basically act as a primary security for cash credit facility, but bank will also insist on collateral security, because in the event of failure or default by borrower, the first asset that gets disappeared in most of the cases is the primary security. Okay, that is the inventory, and receivables will be of very meager value or even nil value. That's why banks are very particular about collateral security. Okay, then in cash credit, interest will be levied only on outstanding balances and it is not levied on sanction limit. So every day end balance will be taken into consideration for arriving at interest amount, and this will be generally debited at the close of the month, and borrower should service that interest immediately. Okay, and when banks sanction cash credit facility, they do so on the assumption that borrower will be making optimum utilization of the sanction limit. When this facility is sanctioned, whenever the borrower comes for withdrawal, bank should be in a position to allow that withdrawal, provided it is within the drawing power. So for this purpose, bank should set aside sanction limit to meet borrower's requirement. I mean, bank should set aside cash for meeting the borrower's requirement. In case borrower is not going to utilize the limit to the extent expected by the bank, it would result in opportunity loss for the bank, because bank has set aside some funds for this customer, but he is not utilizing the same, and interest is going to be charged only on the outstanding balances. So bank is at loss here. To overcome the situation, banks will generally stipulate a charge called commitment charges, and this charge will be levied when cash credit facility is not utilized up to a certain level, say something like 60 to 70%, and this could vary from bank to bank. So much, we have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like auto credit facilities, letter of credit and all. So far I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, Collateral Securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10. In this course, you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over. Some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.